Hello, chart watchers, and welcome to this Tuesday, September 18th Market Watchers live show with your hosts, Tom Bowley and Aaron Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, we've got some action taking place here on the markets again today. We got the Dow Jones Industrial Average trying to break out back above recent highs, currently up 149 points to 26,211. The S&P 500 bouncing off that 20-day moving average, also recovering all the losses from yesterday, currently up 19 points, back above 2,900 to 2,908. The NASDAQ hasn't picked up all the losses from yesterday, but a pretty strong day nonetheless, up 84 points, currently at 79.79. Russell 2000 still lagging on a relative basis, but after failing to hold on to 1707 price support yesterday, closing at 1703, we are back up above that 1707 level. So at least in the short term, a positive there. Big news today, 10-year Treasury yield up to 3.04%, up about 3.5 basis points. And after clearing that 301 level intraday yesterday, looks like we're going to try to confirm a close above it today. We'll talk about that 10-year Treasury yield a little bit more in just a minute. Volatility, which seemed to be on the rise yesterday, giving back a lot of those gains, currently down nearly 8% today on the VIX. Leading to the upside, and this is where the market kind of flipped from what we saw yesterday. Yesterday, we saw a lot of weakness in consumer discretionary and technology. These are the two groups leading to the upside today. Up 1.45 there on the, or 1.45% on the consumer discretionary. Technology up about a little over 1% today. You've got consumer staples on the flip side, down actually about 0.5% right now. And these were the three worst performers today in the S&P 500, and they were all earnings-related drops. General Mills down more than 8%, FedEx taking on the chin down about close to 5%, and AutoZone down 24 points today. All three really struggling. All right, Aaron, well, yesterday it looked like we were in big trouble in the market. Today we're getting a big bounce. This is what you want to see, I guess, from a bullish perspective, is quickly recapture some of the areas that we lost yesterday, but kind of volatile action.
Yeah, absolutely. It's a little surprising for me, but not completely. I mean, my indicators have been talking about, the short-term ones have been rising, and they're not quite overbought yet, but I bet today they will become overbought. So I think caution will be needed later in the week, but we'll see.
Yeah, I always get a little nervous this time of the year. And I've got some numbers for everybody I'll share in just a little bit, but just this time of September isn't particularly strong. Well, let me just say it's bearish. It's not that it's not particularly not strong at all. And even throughout this entire bull market that we've been in since 2009, this period that we've entered historically has not done well, even during this bull market. So, but anyway, I got some numbers I'll share in just a couple minutes, but what do we got going on today?
All right. Well, this week is going to continue to be exciting as always. Today I'm doing my workshop, but tomorrow we do have David Keller coming in, the mindful investor. And then Julius de Kempener is going to join us on Thursday to talk RRG, I am sure. And Mary Ellen McConaughey will be back with us on Friday. Looking forward to talking to her again. I think we're going to have her on a little more regularly. Everybody seems to be liking her style of analysis. Today's agenda, I'm going to do a step-by-step scanning and alerts workshop. I think it'll be helpful for beginner. Well, I know it'll be helpful for beginners, but I think it might cement some of the concepts to our advanced users. 10 and 10 to 1, our first stock will be Las Vegas Sands Corp, LVS, and then we'll finish it off with Inside the Lines. Tom will take that over at the end of the show. But let's go ahead and get started. I'm sure, well, you have all those interesting numbers I'm dying to hear about, so let's go ahead and get started.
All right, sounds good. First, let's take a look at the 10-year Treasury yield. You can see the big move up we've seen over the last 3 to 4 weeks. We were down at 2.81%, testing the earlier low that we saw in first week of July, but we held that area, bounced back up, and you can see ever since we gapped down at the end of May, we've really struggled to get through 3%, 3.01%. Yesterday, we got up to 302, but we weren't able to close there. Now today, it looks like we're trying to really make this breakout here. And anytime you get a breakout in the 10-year Treasury yield, that means that we're getting a breakdown in Treasury prices, and that money has to go somewhere. Normally, if the 10-year Treasury yield is rising, it's telling us that the economy is getting stronger, or at least the market believes it's getting stronger. And that normally means money rotates out of Treasuries and into the stock market. So this is a good thing. There's a lot of mixed signals right now in the market. And to be honest, I'm kind of confused as to which way I think the market's going to go here. But this is one of the bullish things. If you got the check mark on the bulls column and the bears column, this one right here, I think, goes directly in the bulls column for the stock market. So we are getting this breakout here. I think that bodes very well for the economy down the road. And I think sets up now perhaps a test of the May high around 3.11%. If we stretch this chart out and go back, I'll start with 3 years, but I think we're going to need to go back further than that. Let's stretch this out and go back during the entire bull market. This is a weekly chart on the 10-year Treasury yield. But you can see when we get up to 311, you might argue, okay, that was a false breakout above this 3% area we saw in 2014. But if we do it again, I'm not sure you could call that a false breakout. The other thing is that we stayed in this decline. So every time the PPO on a weekly basis on the TNX would get above zero, we just go right back down below. And we've seen this over and over and over again throughout the last several decades. But here you can see we actually started a big move up off the mid 2016 low, and the PPO went positive, and we've stayed in positive territory now, going on close to 2 years with just, maybe one little brief push to the downside. This is unusual and something we haven't really experienced in a long time, but I think it's telling us that the long-term downtrend in Treasury yields has ended, and we are starting to see much more momentum to the upside. And I think that this is going to be an area, this 311 level is going to be an area we really want to watch closely. Okay, I'm going to bring up the S&P 500 chart. I don't have the numbers showing up on the chart, so I'm going to read them to you. But these are some very interesting numbers as far as I'm concerned. Going back the last 10 years, I'm going to give you the number where the S&P 500 was on September 16th close. Now, this year, of course, September 16th was Sunday, so we'd have to go back to the 14th, which was Friday. But each year, I'm going to give you the number going forward and give you where we started the period in September and where we ended it. So in 2017, last year, heading into this September 17th to September 26th period, the S&P was at 2,500, and we ended the period September 26th. We ended at 2,496. So we were down 4 points, no big deal. In 2016, we started at 2,139. We ended at 2,146. So we're up 7 points, kind of flat. 2015, 1995 to 1931. So we went down 64 points, more than 3%. 2014, 1999 to 1982. So we lost 17 points, which was about 1%. 2013, 1698 started the period, 1698 ended the period, flat. 2012, 1465 down to 1433. So we were down more than 2%. 2011, from 1216 to 1163. So that was down 53 points. That was more than 4%. 2010, 1124 down, or excuse me, this went up to 1148, up 24 points. That was up 2%. That was by far the best year during the bull market that we've seen from September 17 through 26. 2009, we went from 1,068 to 1,044, down 24 points. 2008, actually, we were flat in 2008, even though that was during the bear market, kind of surprising. But we had 4 days during that period where we either had a gain or a loss of 3.8%. It was incredibly volatile, but it did manage to finish that period flat. 2007, this was right before the bear market started. If you remember, we topped in October of 2007. But in September 2007, this period began 1484, ended at 1525. So we actually had a pretty good period right before we topped in that bear market, or started that bear market. All right, 2006, I'm not going to give you all the numbers, but I'll give you roughly the percentages. 2006, we were up about 1%. 2005, down 2%. 2004, down 1%. 2003, down about 3%. 2002, down about 5%. 2001 down 8.5%. 2000 down almost 3%. I think you're kind of getting my drift. This has not been a good period. There's only this century, I think, based on everything I just read, there's really only been about 2 years where we've had made any significant headway from September 17th through September 26th. So yesterday was the 17th, today's the 18th. So we lost a bunch yesterday. We're getting it back today. We're essentially unchanged, maybe up just a point or two on the S&P 500, but for the most part, kind of flat so far. And we still have another week or a little bit more than a week to go in this period. So it's hard for me to get overly excited about the market, even though the 10-year Treasury yield's moving higher, meaning that money will likely rotate into equities. It's hard to get excited when you know the history at this time of the year is not very strong. And I mentioned this yesterday, but I think a lot of the problem is that you get into a situation where companies are running out of time in terms of disclosing their dirty laundry. And I think the second half of September is kind of like everybody just kind of throws in the towel and says, or at least companies that aren't going to make it, aren't going to make their numbers. They'll throw in the towel and say, well, here's our warning. We're not going to hit. And so I think the market has a tendency to see a little bit more of that. No studies here, so that's just my opinion. But kind of makes sense that I think as you get toward the end of September, you get closer to earnings season, we could begin to see some more warnings. Today, I mentioned the 3 companies that reported earnings. One was General Mills, GIS. You can see General Mills getting hit pretty hard to the downside. FedEx reported, and FedEx, I think they reported yesterday after the bell, but here you can see FedEx going down, so far holding its 50-day moving average. And then finally, the last one was AutoZone, and AutoZone gapping down, bouncing so far off of that low from earlier where we opened down around 710, but we still are down about 22 points on the day, almost 3%. And it looks like it could be a little bit of a change of character. We'll have to see whether or not we get back through the 50-day moving average. So when I look at the S&P 500, getting back to that, and let's pull up a longer-term weekly chart. I'm going to go back. Let's just go throughout the, let's go through that throughout the bull market. What you're going to see recently, which is very similar to what we saw from 2012 all the way through 2015, so for about 4 years, we really didn't go below the rising 20-day moving, 20-week moving average very often. We did so toward the beginning of the fourth quarter of 2014, but then we made another rally into year end, setting a new high. But you can see this was a pretty steady move to the upside, and it seems like we're on that same path right now, where we occasionally go down below the 20-week moving average, but not really much. So I think we're still in a very strong bull market. I am not bearish at all, other than maybe just a little bit concerned in the near term. And when I look at the 20-week moving average on the S&P, it's at 2816, which is almost 100 points below where we are right now. Now, I'm not saying we're going to drop 100 points, but I wouldn't be shocked if we did, just because as I went through all of those last 18 years worth of data on this September period, we have had some of those 4 or 5% drops, even though they've been, in otherwise bullish periods, or at least a couple of them were. So I think that we could pull back just because of historical issues, but I'm still going to be bullish heading into the fourth quarter. I think the market goes higher. I think we'll be setting new highs. And if we can get a breakout on the 10-year Treasury yield above 311, to me, that suggests that the market is really anticipating much stronger economic activity ahead, which would lead to higher profits on the S&P and in turn lead to higher prices on the S&P 500 as we move forward. Okay, I mentioned also, I might as well pull up the NASDAQ before I get into the upgrades and downgrades. But here you can see the NASDAQ doing the same thing, for the most part, just trading above its 20-week moving average. And that is currently 240 points below where we are right now. So the NASDAQ could pull back 3%, and we would just simply get one of these 20-week moving average tests. I'm not saying we're going down there. I just wouldn't be overly concerned. I wouldn't panic out if we were to drop 2 or 3% on the NASDAQ. Two groups that were struggling yesterday in the market and currently rebounding. You've got broadline retailers, went down below the 20-day, big bounce back up, essentially getting right back to where we opened yesterday. And then the other one was the specialty retailers, which also had a rough day yesterday, but getting back most of its gains today. And we're seeing companies like Netflix bouncing up pretty nicely. Although, again, all it's doing is getting back what it lost yesterday. No big breakouts. I wouldn't read too much into this. I think that, and you can see the volume's just kind of moderate today, not anything special. So I think it's just a little bit of back and forth whipsaw that we talked about at the open. Okay, we got a few upgrades and downgrades, so I'll go through those with you. Let's start off with the upgrades. IMGN. This was a company that was doing really well. This is a biotech, but it has fallen upon some harder times. And let's take a look at using a 1-year chart. But you can see the downtrend. I mean, we lost what was pretty good support around 9.5 to 10. I will say, though, after we saw some real heavy volume come in January, there was gap support at about 830. And you notice these tails with heavy volume going below that level, but we didn't close below that 830 area. So if we continue to weaken, you can see we went down just a little bit below 850 earlier in August. I think another move down to that level could be worth a shot, but I'd have to see how the overall group was acting as well. Marvell Technology upgraded. Here was a breakdown below multiple support levels recently, around 1950 to 1975. That was also a gap area, a nice support area in there, and we've lost it with heavy volume. So this is a change in character on the chart for Marvell. I would be careful here with this one. It's a little oversold, so we could get a bounce, but really I would watch that 20-day moving average because that is also lining up with price resistance. LB, another upgrade. Not sure why. Had pretty good price support around 30. We broke down on major volume. I would actually, if I was shorting this market, this would be a stock I would short. I think you got good gap resistance and the 50-day moving average and price resistance all coming together at about $30. You could keep a fairly tight stop if you say break out above, you see a close over, say 30, 50, 31. But to the downside, I think you can easily go back and retest those lows. MD. This is Mednax. This one's looking a little better. I like the volume coming in. Nice little flagpole and flag action. But I want to see this breakout. A breakout above 49, I think, could move all the way back up to the top of this gap resistance around 53. So Mednax is one that I actually do like a little bit among the upgrades. TRGP, not liking this candle. I like the uptrend. But if we fail to get this breakout with the uptrend, I think we'll at least get back down maybe and test that rising 20-day. Among the downgrades, there were a few of these as well. WK, which is Workiva. We did down, I think maybe some of these downgrades because the charts aren't too bad on a few of them. But this one looks like maybe as a valuation. Stock went from 26 to 40 in a month, more than a 50% rise. So it's probably some sort of a valuation downgrade. But you can see once it sold off, a lot of folks jumping back in. I think this one might need some time to settle down, but that tail where it went down to earlier today likely will provide support as we move forward. Fortinet, FTNT, another really nice move up. The stock's been uptrending for quite some time. It gets a downgrade, gets near the 20-day, and the buyers step right back up. Red Hat, this one's a little bit more, I like the group. It's in software. But after the gap down with massive volume, it has struggled to get through about 150. I don't know if that was maybe a little head fake. I think in the near term, maybe 138 to about 152, 153. Watch that range. But I think this one's just kind of neutral for me right now. UAL, moving on to the airlines. Nice move up. A little bit of a negative divergence. Maybe we get back to the 20-day. If we fail to hold the 20 and the volume picks up, then I think we got a shot at the 50-day given that negative divergence. But again, this is one probably being downgraded based on valuation. PRI, same thing. Primerica, big move to the upside. Negative divergence. We got a 50-day test. That may be the end of the selling on this one. And the last one I have is PLYA, which is Playa, hotels and resorts. And I got a problem with this one because if we go back a little ways, 3 years, we lost some pretty key support here going back. This 950 area has been very big support. Volume picking up, we're losing it. It's in that gambling space, which has been weak. So I would avoid that stock for now. Okay, it is time for Aaron's workshop. What do you have? I know you got scans and you're going to do a step-by-step, so looking forward to it.
Yes, and actually somebody had given me the idea to expand it a little bit into going into alerts. So I'm going to do that as well. Let's go ahead and get this started. All right, here we go. Yeah, so I'm going to do not only the scanning, but I'm also going to sort of take it to the next level and help you develop alerts from your scans. So we do have predefined alerts and of course price alerts, but a lot of people aren't familiar with the advanced scanning or the advanced alerts. And so I'm going to show you how you can use those to set up alerts with your scans, which can be very helpful. So let us get started. So here's kind of what I'm going to cover. The first thing is about membership level. You do have to be at least a basic member to access our predefined scans, which I will show you and how you can do that. You need to be extra or above service level if you want to create and save your own scans, manipulate predefined scans. I'll show you how to do that. But if you want to do this, what I'm showing you, you'll know based on your service level what you can and can't do. And honestly, I think one of the best reasons to get involved and join stock charts are the scanning abilities. I don't think anybody has scans that are quite as robust as what stockcharts.com offers. So I'll go over predefined scans, and then I'll show you how to create your own scan, and we'll go through an example. And then we're going to look at how to modify predefined scans, which is going to be kind of a hybrid between the two, the predefined and your own created scans. And then we're going to look at setting price alerts and advanced alerts, the advanced alerts using your own scans. So let's go ahead and get started. There's a lot to cover here, isn't there? So here's the membership levels so that you know what you can and can't do. As you can see with basic, you do get those predefined scans. And when you get to extra, now you have 5 custom technical alerts and 200 custom scans. And then when you move to that pro level, you get 300 custom scans and 50 custom technical alerts. So just so you know what you need, what you maybe don't need, I wanted to make sure that was pretty clear so everybody knows. All right, so let's start off with predefined scans. We're going to look at, you have to have the basic membership. They're on the member homepage, and I'm going to take us right over there and how you run it. And then I'm going to talk to you about saving the results and my scan dump and how I recommend that you use the same. So let's go ahead and look at the predefined alerts from the member homepage. All right. So if you move down this way, you can get to your scans. Let's see if I can get to my arrow. All righty. Hang on just a moment. I can see what I have to do in order to get to my arrow now. Here we go. There we go. All right, so you can, scroll down here. If you have set it up, I should say here, if you have in settings, scans and alerts checkmarked, you're going to have that right on your dashboard. So you might want to consider adding that if you don't have it already. You can come down here and you can say, oh, I want to go to the advanced scan workbench. So you could go straight into the workbench, but we're not going to do that yet. We're going to look at the predefined scans. So I'm going to take us down to the scanning. There we go. And in that scanning box is where you can find the predefined scans. So I'm going to click on those. And I know that we talk about these quite a bit, mainly because they are so helpful. And Tom and I use these all the time to create the scans for looking for momentum stocks, looking for bottom fishing opportunities. A lot of these you can use just to find those kinds of stocks. So it's really great. It tells you right here. So here's how many are currently the stocks that we cover, how many are having new 52-week highs. Right now there's 185, and that's actually down by 42 from yesterday. So that gives you an idea of sort of where the market may be moving just by looking at what is going on with these green and red bars. Earlier when I was on this and looking, all of these bars were red except for one green. So it tells me now we're getting plus signs here. We're getting more and more moving above their Keltner channel, above their price channel. So just looking at this page from this morning earlier to now, I'm already going to pick without even into the scan. I kind of know already that clearly things are improving today because it was all red and now it is green. All right, so let's go ahead and let's look at the new 52-week highs. So I'm going to just click on it here. This gives us all of those that are in here. Now, if I want to look at all of them and all 185, I can do that. I need to save the results so that I can really look at them and manipulate them. And this is where the scan dump chart list comes in. I always replace a chart list with the results. I don't like to merge because then I don't know what I had before and whether I'm mixing in. I prefer to just, when I get scan results, I want to put them all in one chart list and deal with it there. I could create a new chart list, but then you end up with, oh my gosh, I used to do that and I had about 50 scan results chart lists at the bottom of my list of chart lists, and I didn't like that. It got really hard to tell it apart, and it was better if I saved it to a chart list that I could remember and understand. So I find it to be the best, and that's my personal opinion, to replace a chart list with your results. And I have a chart list that I have named Scan Dump. I put asterisks around it so that it will show up at the top because I have a lot of chart lists here. So I want to make sure I can find what I need to find quickly. And so I use a chart list. It's called Scan Dump, and it's only for transient scan results. It's only for those things that I'm just trying to kind of grab a hold of, look at all at once, manipulate. And then when I find something interesting in this, then I go and save it to a chart list. I can save it to my watch list. I can save it, to the Market Watchers Live list or a Monday Setups list. But this list, Scan Dump, I can annotate here if I want, but the idea is that this chart list is replaced often throughout the day. It's not really where you want to put something to, study over time. Now, I have to say, if you're a basic member, you only get one chart list. So you have to be, really careful about how you name and, merge all of your stocks into that one chart list. So another reason to maybe move up to extra, just so you have those extra chart lists and you can really manipulate the scans and use them that way. So I've now saved them, and see there's my chart list scan dump. So all of those results from that predefined scan are in here. And, as far as manipulating your scan results, I have done workshops on that before. But what I recommend is setting up a candle glance and using candle glance to go through your results, because you can see so many on the same page. And, I look for certain things. I'm concerned about what my PMO is doing. So I set up a candle glance chart style so that it would always show my PMO all on a 6-month chart with the 20, 50, and 200-day EMAs on it. It's very easy to do. You just make your chart. I'll just show you here really quickly. So you go in and you create a chart style called Candle Glance. There you go. And you make it look exactly like you want it to look on your Candle Glance. So here you go. I have my PMO. I have the 20, 50, 200, and it's a 6-month scale. I think it's a 6-month scale. Maybe this one's a year. So anyway, that's how you would get those to look the way you want to when you get your scan results like this. So then I can go through, and having used just the predefined scan, I can look at things that fit my trading style. And that would be PMO crossovers, PMOs that are not overbought but more oversold. But I can also look at price. This looks like a parabolic, so I wouldn't want to be involved in it. I'd be very happy if I'd gotten in about down here, but at this point, that's not something I'm going to be interested in. You can go through and see what works for you. So that's how I save the scans from a predefined scan. So again, you go to the members dashboard, and here is where you can go down to find your scans. Those predefined scans are right here. And I believe you can get to them from up in here too. I can't remember. There you go. Yes, in the Pro Control Center. So you can also, if you don't have the scans alert button checked, you can always go over here to find the predefined scans, and it'll take you to that page I just showed you. All right, so let's get back to our slides here. Well, of course, I started it from the beginning. All right. Now we're going to look at creating our own scan. And again, you do need to be an extra member or above in order to do this. You can go to the member homepage, and that's where I'll show you how you can get to your scanning workbench. I'm going to show you just some typical coding language that's already there for you to make it easier to create your own scan. I want to talk to you about how you can use comments. Comments, I think, are critical when I have my own scans, especially. And it also helps you increase your results. And that's what I'm going to talk about as well. So if you run a scan, you only get 5 results. Well, you can comment out certain code so that it will now open up your universe a little bit wider. So we'll look at how to do that as well. So let's go ahead to creating our own scan. And I'm going to go back to our member homepage. Again, I keep losing my. Alrighty. There we go. So we're going to go back to the member homepage, and you can go directly into that advanced scanning workbench from right here, or you can go down to your scanning tool down here, and you can create a new scan by just clicking this button. All right, so just I want to run through what the workbench looks like. We're going to do an example of creating our own scan in just a moment, but I just want to help you understand what you're looking at first of all. I have my favorite scans that I have saved over time. I have linked to them in our Market Watchers live recap. I've written plenty of scan blog articles, so you can find some of my favorite scans. And I know I did a workshop, I think about a little over a month ago, and I went through my favorite scans. So that's somewhere you can go to copy and paste, or retype the scans that you might like that I already have. But we're going to go ahead and start with our own. Here's where you save, obviously, and viewing all of your scans. You can start with your scan starting before, 0 trading days before, or you can say, now start it, 5 days before. I want to have my results be a little bit more open. So I'll put it, actually, we'll start at 9 trading days before. And that would be before the last intraday update. So now I've opened the following criteria to 9 trading days before. Typically, I just use it at 0, but this is just for an example. When you open the advanced scanning workbench, it's already going to have some code in here already. All right. And it's always the 20-day simple moving average of the daily volume of a stock being 40,000 or above. So I usually will change this right off the bat to something larger because I want something that's got higher volume numbers. So we'll make it 100,000. We won't make it too much higher. And the type is a stock. Now, the nice thing about the workbench is it sets up where you can add code really quite easily by using, here's also where you can grab one of those predefined scans and just add it into your scanning language. And that makes it pretty easy as well. If you wanted to add in, for example, a bullish MACD crossover. I clicked on that and I'm going to add, and there it goes. It's got all of the scan language that basically will tell you that the MACD has had a crossover after rising for a certain amount of days. So you can easily add those predefined scans that way. There are your, you can add price, volume. We already have a volume one, but if I wanted to add, say, the scooter in there, I can just click on that and it adds right in there for me. And then I can change it to whatever I'd like. Let's say 50 instead. Maybe I also want it to be less than a certain amount, so I can copy it, paste it in here. And I'm going to change that to the less than sign. And we want it, let's say we want it less than 90. Not 990. All right, so now we've got a stock that is, has the daily 20-day moving average of the daily volume greater than 100,000, and we have a scooter greater than 50 and less than 90. Well, I maybe don't want to look at, say, London, India, maybe even Canada. Maybe I would prefer to use just a US stock. So that's where you can go into the ticker properties, and you've got so many different choices here. If it's had a dividend, if how many outstanding shares. I mean, there's certainly lots of choices. I'm just going to show you some of the ones we use more often than others. So again, I chose it. Oh, right there, I chose country. Now I'm going to add it, and there you go, country US. Now, one of the things I would recommend, I don't know if any of you are programmers from back in the day or are programmers now, but one of the things that you might want to consider just to make it easier on our scan engine is to pick the big ones like this, the ones that open a large universe, and put those near the top. It just helps our scan engine. So it helps the scan engine to go, oh, you know what, it's a stock and it's in the US. It makes it very quick and easy for it to determine that, and then it can go more quickly through the rest of the steps. Now, when you create your own scan, I highly, highly recommend that you use comments and comment code. And I'm going to show you an example in one of the scans I already have. So let's look at my general PMO scan. In this scan, you can find as a link at the bottom of all of the Market Watchers live recap blog articles. Recommend you go there if you haven't already. It's a great way to catch up with what we did on the program, and there are timestamps if you want to go watch it on YouTube to save time. So recommend you check out that Market Watchers live recap. And at the bottom, like I said, is a link to this particular scan. So using the double hash, it's not a hash, it's forward slashes. By using a double in front of that line, that makes it a comment. That means the scan engine can ignore anything after it on the same line. So what I always recommend is to put above a comment on what it is you're looking for and what's happening in the scan code, because it may not be that obvious. And in the case of this scan, I have people using it all the time, and I want them to understand the coding as well. So recommend that you always use the comments on your codes. And there you go. So now I'm going to run this particular scan right here, my PMO scan, and just see what we're coming up with right now. There we go. We have 15 entries. And like I was saying, I can go in, I can replace an existing chart list, my scan dump. Now remember, we have like, what it was at 184 stocks already in there, but I put them in there because I knew that I didn't care if I wrote them over. So again, I'm going to use this as my regular place to dump my scan results. And there we go. So now I only have the ones that we got from that PMO scan. And then as I usually tell you, go to your candle glance. That's the best place to go and really get an overview of what you might want to look at and what you might want to just get rid of. So for example, breakaway gap, continuation gap. While this one could continue up, I feel like it's already made quite a move. And also, I think you might be able to look at that and be a little concerned about an island. So I'm going to just take that one out. PMO looked good, but I didn't want to get involved in something that's already had such a long run. I'm looking at this one right here, and I like that PMO setup. And this looks like it could be a flag with maybe a pennant on it. Pennants are continuations. They're smaller symmetrical triangles. So that one might be interesting to look at. So anyway, that's how I can get the scan results. I can dump them in, and then I can have the opportunity to look them over. All right. Let's say I want to have more results than what I just got. Let's just say I only care if the 50-day EMA is above the 200. I don't care right now about the 20 being above the 50. So I'm going to comment it out, just adding those forward slash marks. Check your syntax. It's always a good idea. Of course, I only commented out a line, so I shouldn't have a problem with that, and I did not. And now I'm going to run the scan. And we had, I think it was 18 results. How many did I get this time? Well, 17. It must have been 15, and we added 2 more. All right, well, I want to look at more than that. So I'm going to come back here, and I'm going to say, you know what? I don't care what the EMAs are doing. I'm going to just comment those out. And I'm going to run it again. Let's see here. $17. So that didn't help. So that's telling me that although I commented out those lines, that those don't matter. Apparently, they were all together working anyway. So interesting. I've never seen that one happen. So I'm going to see if this is working right. And we'll might need to save it, but we'll see. There we go. So by the commenting out the scooter being above 75, I've now gotten 105. So now maybe I do want to add one of these back in. So I'm going to add in that 50, 200 day EMA, and let's run it one more time. And now we have 59. So that suits me. I'm happy to look at that. That makes a lot of sense. Okay, so let's go back to our PowerPoint here. So I've told you all of those, how to save it, but really that important thing, comment codes to increase your results. I don't think everybody thinks about that when they're developing their own code. So I thought it would be an interesting thing to do a creation example. What I'm looking for, small mid-cap stock, 20-day moving average of the volume above 200,000. Want it to be from the US, above $10, but less than 500. It's trading above its 20-day EMA, and the 50-day EMA is greater than the 200. Well, let's break it down. All right, so we want a US stock, 20-day moving average above 200,000. So I know that one we should be able to get to pretty easily here. Okay, go back here. And we're going to create our own new scan. So let's see. All righty. I know that there is a way for me to make a new one. I'll go to the dashboard since I know exactly how to get to that. New scan. All right, so we decided that we were looking for 20-day moving average greater than on volume above 200,000. So I'm just going to fix that. It's a stock, so that's good, but we need it to be from the US. So I'm going to do that. Country US. There we go. And then I want it to be a smaller mid-cap stock. So I'm going to come over here into indexes and say, okay, I want to have it be in the S&P 400, or I want it to be in the S&P 600. Now notice I said or, because we can't have it in both. I mean, I think there might, not in this case, but sometimes you have overlap, but we don't in this case, so I need it to be an or. All right, we want price greater than $10. Okay, it's like I lost my arrow again. All righty. Okay, so we wanted it above $10. I think you get the idea. I don't know if I'm going to have time to run through all of it. So we want it to have, there it is, a close above $10, we said, but less than 500. So I'm just going to copy and paste that, make that a less than. There we go. And I think you get the idea. And when we were talking about the moving averages, adding those in, you could come in here. Let's see, various ticker properties. Let's see. Okay. Oh, look, that's where you can also do exchange traded funds and get all of those. All right, I'm going to move us back to one that I already have just to make it easier. All right. So there's where I have that PMO. We did the MACD one. Today's EMA is 50. The 50-day EMA is above the 200. I think you get the idea there. All right, we're running low on time, and I want to be able to get through all of this. So we ran the scan. I showed you how to save it to scan dump. We looked at how to do that with Candle Glance. To do the hybrid scans, I showed you how you could add predefined scans just straight from the workbench right over here. They're all in there. Or you can do it from the member homepage by going to predefined scans. And then once you pick one, up in the corner is where you can edit it, and it starts it right off with that code for you. All right, we did a sample scan. I showed you how to save them. So really all you have to do is you can add it in through the workbench to get a hybrid, or you can use it from that predefined scan page, which works pretty nicely actually. All right, so I want to take it to the next level and show you how to do price alerts and advanced alerts. And the best way to do this, honestly, is to split your screen. So I've already set it up here. And, you know, I'm going to say that I'm looking for an alert that's going to give me this information. So I want to edit it, and I need to see what it looks like. All right, so now I also want to do an alert. I want to create an alert from that. Now, I'm not going to show you price alerts because honestly, those are probably the easiest ones here. You can just have them alert you. You just put in your symbol above or below a certain price. So let's just say the SPY, when it gets 2%, 5% goes 5% up, tells that already figures out the cost, price, I mean. And then here's where you could also convert it to our advanced alert board. So price alerts, advanced alerts. We want an advanced alert, and we're going to add a new one. And I want the results from this to become an alert. I just copy it, and I paste it into the alerts, and I save that alert. And I can give it any kind of name I want. I'll just say alert example. And now whenever this alert runs, and if I get results, it will tell me via email. And you can pause it after the alert. You can continue it if you want. It's up to you how you want to set that up. But that's really, it's not that hard to move to an alert. And I find it much easier to use the split screen in order to make those copies, or to take pieces of one scan and put it into an alert scan. All right. So here are the takeaways that I have for you that I want you to remember. Membership levels are important as far as scanning and alerts. That tells you what you can and can't do. Recommend extra level or above, and you can do all of the things I just showed you. You can use those predefined scans on their own, or you can create a hybrid. And I use that split screen. I think the scan dump chart list is absolutely the best thing I ever learned, and I learned it from Greg Schnell. Remember how to use comment code and comment lines. I think that really is helpful. And then the price alerts and advanced alerts are honestly a matter of copying and pasting your scans into the alert workbench. It's pretty much that easy. And again, I think using the split screen for that makes it the easiest. And that's all I had for you today on step-by-step scanning. I hope that was helpful, and I will probably do a little bit more on the scanning manipulation to create those hybrids, but a lot of that will be done, as you watch the show. All right.
Excellent job, Aaron.
Thank you. And now it's time for that 10 and 10, and I did get some of them in already. But I do need to get some more in that have been requested. I recommend that you go and like the ones that you have, and the one that is the most popular will be the second one that we'll do. So you'll definitely want to add that. So at this point, I'm going to have you go right into, I think our first one, Las Vegas Sands, and I'll get this list ready. We won't have a chance to do the RRG today just because I was doing the workshop.
All right, sounds good. Let's take a look at Las Vegas Sands. I actually did this on a relative chart, and I used a 2-year time frame to show you a longer term breakdown that I'm seeing here on the stock. I think that this was a character change. You talk about that a lot, where you've got a stock that's trending in a certain direction, and then something happens, usually on big volume, that changes the appearance of the chart. So here's Las Vegas Sands. I think clearly for about a year and 3 months, year and 4 months, we had a nice uptrend in play. You can see when we would pull back, we'd actually hold the prior lows. So we had this steady higher high, higher low kind of thing. You can see here in February, March, April time frame, we had multiple lows come down and hold 67.5, and then push to our final high in June. And something strange happened at the end of June. You can see that Las Vegas Sands took a move to the downside. Didn't really break the trend line, but notice that the overall group, if you go back and connect the lows over the same time frame, that the gambling index did actually break down at the end of June. And it was just another week or so, maybe a week and a half later, that we saw a big gap down on Las Vegas Sands. This may have been earnings related, but that was a big gap. We went from, I don't know, maybe $76, went down, closed probably around 70, and then made our way back up. One final fateful move to the upside, got close to price resistance, gap resistance, and then turned back down again. And you can see the volume has been very heavy. When you look back during the selling on any of these prior episodes, it was nothing like what we have seen over the past 3 to 4 months. So I think we are now in a downtrend on Las Vegas Sands. We are in a bull market, so I expect at some point we will get a pop and maybe start an uptrend, but I need to see that pop first. I wouldn't want to just try and jump in and catch this falling knife. We're talking about less than 3 months. The stock's gone from 80 down to 60. So it's lost about 25% of its market cap in less than 3 months. I don't know how far it goes. It seems like a lot, but who knows? Maybe it goes all the way back down to the double bottom we saw in 2017 at 47.5 before this is done. I just know that as long as this downtrend remains, and especially the overall group continues pushing lower, it's going to be difficult to do much with Las Vegas Sands. So I don't like it. I think that clearly we are in a downtrend, and you can look at all these different relative charts that I have on here, and they're all downtrending, which tells me to stay away from the group until we see some sort of a character change, maybe an earnings report, gap up, something that breaks the downtrend that we're currently in. So I'm going to pass on LVS.
All right. And our most popular in the chat room looks like AMD.
Well, that is perhaps the best stock in the semi group, certainly one of them. But Advanced Micro Devices has been on fire. Stock was $10 back at the end of April before we started this huge move to the upside. So we've more than tripled in 4 or 5 months. So it might be a little bit too much, but I tell you, there's a lot of accumulation taking place. And I would be a buyer on any 20-day test. We haven't seen that since mid-August. So we're going on probably about 5 weeks. But as you can see, going back throughout this uptrend, any kind of movement down around that 20-day moving average has generally provided pretty good opportunity for entry. So if I'm annotating here, I'm simply going to pull up the chart and just highlight the fact that when we get these 20-day tests, essentially this has been a really good area for entry into the stock. And then maybe the other thing that I would want to note is that the volume has just been extraordinary. So if we pull this up and just kind of highlight that, that's very unusual when we look back to what we've been seeing. Even earlier in this uptrend, we saw some volume, but nothing like we have seen recently. So there's some massive accumulation taking place, in my opinion. And I think what's happening is we're seeing a lot of rotation from other areas in the semiconductors, like in Intel. Intel and AMD are competitors, and clearly the market is choosing AMD right now over Intel. So until that relationship changes, I think AMD is the pick, and I would continue to watch that rising 20-day.
All righty. Let's see. The next one maybe you've heard of, Alibaba.
Yeah, I've heard of it. It's struggled a little bit because a lot of the Chinese stocks have been hurt, and certain, these last 3 or 4 months with all the tariff talk, trade war, trade fears, all of that, it is definitely having an impact on some of these stocks that do a lot of work or a lot of business in China. So I think, Alibaba is in a downtrend. I don't really see anything. I'm going to stretch this chart out just a little bit, take a look maybe at a year and see if there's another support level. Not really. I mean, I think this bounce up and failure at the 20-day moving average tells me all I need to know right now. And that is, I don't really want to be part of this stock and this space. But there was your prior support coming across. And then we went down below it. Look at the volume coming in on that break of support. Yes, we went slightly above, but we failed at the 20-day moving average. I'm just not seeing anything. I'm not going to try and be a hero and catch the exact bottom on a stock like this. I want to see it start to regain some of its strength back to the upside before I'd be interested as a momentum trader. So I'm going to pass on Alibaba for now.
Okay. The next one is VMware. So VMW. PMO looks okay. What do you think?
I like it. I think it's in a cup. And now kind of retreating back into a handle. This one looks really strong to me. And so we got the uptrend and then the cup that I was talking about right here, and then again here. Nice little cup off of an uptrend. So we can draw that in here. There you've got a really nice push to the upside. We do have some overhead resistance. You can see on massive volume, VMware went up to 165, and this cup kind of fitting right in about this 163, 164 area. I think a pullback down, you've got really good support in the low to mid 150s. I think a 20-day test even would be a nice entry into VMware. So this one I like. I think if the uptrend continues, and I think eventually we break above the top of the cup. And when we do, that measurement actually is another 19, 20 bucks higher. So I'd be looking for this one over 180.
All right. That sounds good. Qualcomm. I know we've talked about that in the past. QCOM.
Love it. I mean, there, even with the weakness in the market, there is just no pullback here. Talked about this one a while ago, and I think if I pull up a longer chart, we'll go back 4 years here. You can see, I'm going to go back even further. Let's go 7 years. I'll change it to a weekly chart. But this was a big breakout on Qualcomm. 68 to 70, I owned it for a while, and 68 to 70 was overhead resistance. You can see right there. And then again, the tops that we saw back in 2016, 2017, 2018. But we went right through like a hot knife through butter, really strong volume, push to the upside. Remember, Qualcomm beat top line, beat bottom line, and then announced that huge stock buyback, which was about 1/3 of its market cap. And you don't see too many buybacks like that. It almost guarantees you buyers on any pullback. So I think Qualcomm is just making a big breakout. And this is a stock that I would have in a longer term portfolio until it started to show weakness. I think Qualcomm's on a big run to the upside.
All righty. Let's see, the next one. The person is asking whether they should hold or sell part or all of a position in Union Pacific, UNP. Big gap up today.
Yeah, actually, I was planning on talking about UNP a little bit later in Inside the Lines. That's one of the stocks that I want to talk about. But yeah, nice gap up today. They announced a plan to increase their operating efficiencies going forward, I think by 2020. And the plan is being implemented next month. And the market obviously reacting to it. I think that there are other railroads that might be slightly better, but I don't think you can go wrong here. Nice accumulation, by the way, prior to the announcement this morning, and I think the stock goes higher. I think you can still see that on the PPO. It is breaking out again to the upside. It is close to where the PPO had topped back in May, but I think if you look at the volume here versus then, we got a lot more momentum going right now. So I like the group. I would like to see them pull back a little bit. I'm not sure that's going to be the case going forward. I think you're going to find some really good support on UNP down around 157.5 or so. As a short-term trader, I think the question was whether or not to hold. As a short-term trader, you could always get out and look to try to get back in a little bit cheaper. But from a longer-term perspective, I think this is a nice-looking stock, and I would be okay holding it.
Okay. How about CVS?
All right, CB or CV?
Oh, CVS. I'm sorry. Victor.
All right. Well, let's look this one on the relative chart. Still have some overhead resistance. Here's the good news. CVS on a relative basis among the drug retailers, one of the better ones. So that's the good news. Bad news is we're still trying to recover off the selling that we saw since January. A lot of areas of the market have broken back out above that January high. Drug retailers are not one. In fact, we still have a long way to go to get back up to that January high. So the group has not been very strong, but CVS has been one of the better stocks. You are approaching that January high on CVS, so you might have a limited amount of upside, but so far the action has been very bullish. The pullbacks on the stock, well, the most recent pullback right here, you can see held on to that 20-day moving average, and also this breakout at 72 held on that pullback as well. So I think 72, 73 is your support area to the downside. 82 is your resistance. I think the stock looks good. If there's anything to hold it back, it's just the fact that the overall group is not particularly strong. So you got to ask yourself if you're willing to own a stock that is really strong within a group that's not very strong, or if you'd rather try to stay with the groups that are working. But overall, I think CVS looks good.
All right. This one we talked about a long time ago. Voya.
Yeah, I think the move up in the 10-year Treasury yield is likely to give this stock a lift. We had some underperformance for a while, not just from Voya, but also life insurance in general. And we're trying to make a breakout. I think that this move on the, I think it's 800 to 810. If we had a candle chart there, you would see that's a pretty good area of resistance. We're trying to get through. We're at 798 right now. This, I think Voya, though, has been a pretty good stock. If we look at the longer term, it's been trying to hang on to its longer term support down around 46.5, 47, resistance at 55. I think if we get a breakout in the 10-year Treasury yield, I think Voya's got a good shot to maybe make another run for that 54, 55 area. So watch the 10-year Treasury, because there is a very strong positive correlation between life insurance companies in the direction of that 10-year Treasury yield. But if we get that breakout and we start making a run for 311, life insurance could be a really nice area going forward. So I like Voya.
All right. This one we haven't given any love to for a while. And somebody asked if Carl still owns it. GE. He actually got out of it, oh gosh, shortly after he got into it, but he did manage to get I think he said a 3.5%, 4% gain on it.
Yeah, I'm not a fan of GE. I mean, I think that the long-term chart kind of speaks for itself. I mean, this is just a year, but we went down quite a bit. I mean, we went from 24 to 12 in less than a year. So you're talking about a company that did a 2-for-1 split, except you didn't get the other shares, and not good action. I think the trend line still is pretty weak here and continues to point to lower prices. So I think if we go in here and just kind of connect these highs, you can see we're still battling overhead resistance, trend line resistance. And now we've got a new support area that we want to watch right around this $12 area. But I'm just not seeing it here. This is a group that's not performing well. And clearly GE has been a very, very bad performer within the group relative to the S&P. I just don't see really any need. I'm not somebody trying to catch a bottom. So if GE starts to take off, there'll be plenty of opportunities to get in. I don't want my capital tied up while this thing continues to be under lower.
All right. And the last one, the MEAT group, MEET. And the person said, they just reported some really great earnings, and they're saying it's in their mind, it's close to support. Again, of course, on the 50-day EMA, I can definitely see support. I don't like it because I've got a short-term trend model neutral that's just kicking in today, and a PMO sell signal that looks like it kicked in last week. So I don't think I would be doing anything with it as of yet.
Yeah, I think one of the big problems is you're in the internet space, and that has just not been the place to be lately. And so I think part of this is that the internet has taken a pretty big hit. I think it's probably going to continue. You can see that MEAT relative to the internet's been pretty strong. So you do have one of the better performers, but is it going to be a situation where the internet stocks continue lower? Because I think they do. I think Facebook and Twitter and Snap are all in trouble technically. And that could change, but I want to see it change first. I don't want to just assume it's going to change. And so if the internet stocks continue to lag, I think that's going to weigh on stocks in the group, even the best ones like the MEAT group. So I don't like the fact we had the breakout with good volume above 480 and then failed to hold it along with the 20-day moving average. Again, I think this is a case of the baby being thrown out with the bathwater. It's probably, technically it is one of the better stocks in the group, but that doesn't mean we don't make another run down here for $394 to test this triple bottom. So I would be a little careful with MEAT just because of the group it's in, not so much because of its earnings or how it's performing. And I'd say the same thing about Google. I think Google is a great company in just in a bad space right now. So let's see the group begin to turn around a little bit, and then I think you might have something here with MEAT.
All right. And that concludes the 10 and 10 to 1. And here are the symbols that we did just cover. So you'll find those in the Market Watchers live chart list after the show. So let's go ahead. It's time for our final market update. I'm going to get that ready for us right now. All right, let's see what stocks have been doing since we last looked. Yes, certainly a great run going on, but I think since we talked about it this morning on the show open, we've hit intraday highs at this point, and we're now starting to see a little consolidation, either sideways like on the Dow or to the downside like the S&P 500 and NASDAQ, as well as the S&P 100. I don't think that this is like the end of the world here. Could be forming little flags here on an intraday basis, but just interesting that we were off to the races, and now it does seem to be that we hit a saturation point and are pulling back just a little bit. S&P 400 and small caps also up. Looks like they did their little pullback and are on their way back up toward their intraday highs. TSX just continuing to move higher, currently up 89.17. Treasury yields also up today, 3.042%. So we're now up over 3% currently on the 10-year Treasury yield. UUP, we had a gap down on the open, but the negative territory, it wasn't there for very long. It managed to move up back into positive territory, tested yesterday's close, and is now heading back up. It's now filled about half of the gap from Friday. So we'll have to see if it will continue up and close that gap that we saw intraday between Friday and Monday. Gold, on the meantime, opened up, has moved back down into negative territory, but seems to be finding support right about 113.40. Currently, GLD is reading at 113.45. TLT, big gap down, continuing lower. I've been very bullish on bearish on bonds I'm not surprised to see this big decline. USO has been very choppy in its trading. Today we did get the big gap up, but it did pull back about almost half of the profits from this morning on that big move to those intraday highs. Currently, USO is at 1466. And that concludes the final market update. Tom, did you want to add something to that before you got on to the final segment?
Yeah, I wanted to talk a little bit just for a second about that life insurance. I just made that comment a minute ago about the correlation between the 10-year Treasury yield and the direction of life insurance stocks. And this is going back 10 years. So this is basically throughout this bull market. The top chart here is the 10-year Treasury yield. And the bottom chart is the correlation between the direction of the 10-year Treasury yield and the direction of life insurance stocks, the index. And you can see that it is positive almost the entire time. We've had a couple dips, including one earlier in 2018, where we saw initially a move to the upside in the 10-year Treasury yield. And we know that the life insurance stocks have been struggling, but you can see that this correlation is beginning to strengthen again, moving back toward that one level where we've seen it plenty of times. So if we get a breakout on the 10-year Treasury yield, you should be expecting life insurance stocks to do well. And that was one of the reasons why I mentioned I like Voya and a number of these different life insurance stocks, because the correlation lines up, technicals line up, and if we get that breakout to a multi-year high in the 10-year Treasury yield, we should be seeing stocks like life insurance stocks, bank stocks moving up for the ride as well, because they do tend to have a very strong positive correlation to the 10-year Treasury yield. Okay, I am going to go ahead into the Inside the Lines segment. Just to give you a brief little snippet on this segment, what we try to do is take a look into the technical picture for stocks that are in the news. So, you always hear news, and that, you might hear some good news about stocks, but it still gets down to what the price action is telling us. So Inside the Lines is really taking stocks that we've got news out there and looking inside the lines, looking at the charts. Do they make sense? Do the technicals line up with what we're hearing from a fundamental perspective? Because sometimes they're opposite. And if they're opposite, I'm going to follow the charts almost every time. So let's take a look first at Avon Products. Avon came out this morning, and they said that they are attracting interest from Natura Cosmetics, according to the Wall Street Journal. Now, if you take a look at this chart, you see a nice little breakout, and you can see the volume picking up. So your initial response, especially looking at the 6-month chart, is, hey, maybe this is something I want to jump into. Well, I would probably be a little careful with that because this is a company that has been downtrending for quite some time. In fact, let's just go ahead and take a look at this beautiful move that Avon has made throughout the bull market. And this is when the bull market ended. We saw a little bit of strength back in 2009. And since then, this thing has just been searching for a bottom. Now, you might be interested in taking this news from the Wall Street Journal and saying, oh, maybe they're going to get bought out, and pin your hopes and dreams on that buyout. But what the chart's been telling me is that Avon Products is not a particularly good company. It has struggled for many years now in the midst of one of our strongest bull markets. And so if you want to get involved with Avon in a market like we've had, with the performance that you see right here, all I can say is best of luck. I think we continue to trend lower, and this is probably one of the pops that that we've seen in the past, probably before another leg lower. And if it turns out that there is no such interest, and this company comes out and announces, oh, by the way, we're not really interested in Avon, then you're probably going to see all these gains evaporate pretty quickly. So I think the risk is too great. I would not be touching Avon Products, despite what the Wall Street Journal is reporting. I think this is one of those cases where maybe the fundamental news and on the surface it looks really good and tempting, but the stock market is telling us something completely different about Avon Products. So I would avoid it. The next company in the news I wanted to talk about, UNP. We just talked about that a little bit, Union Pacific. They are launching their Unified Plan 2020, and essentially they're rolling it out on October 1st, and they're going to be rolling it out in phases. And what they're basically trying to do is to improve their operating efficiencies. And the market loves it. Big gap up today. You can see the stock up 4.5%. And if we go to the relative chart, you will see that it has been moving higher. However, the railroads have been moving higher. And in fact, the railroads have been moving higher faster than Union Pacific. So, yes, we're getting a nice little pop here in September, but we're not really breaking out relative to the railroads. I think part of the strength that we're seeing is simply the rising tide lifts all boats kind of a thing, where railroads have just been very strong. And so if you're a railroad, you pretty much are just going higher. There are some other stocks in here. I think what was the one I was looking at? I think it was Norfolk Southern, which is NSC. I think was looking a little bit better to me. It also is up almost 4%. But when you're looking at a relative chart, look at the NSC breaking out relative to the railroads. So, yes, UNP looks good, mostly because it's in a really strong group. I think after the gap up, though, and the fact that it had been underperforming prior to this announcement today, I might use the strength in Union Pacific maybe to move into another stock. If not NSC, maybe something like CSX, which also has pulled back here over the last few weeks. So on a relative basis, it was at a recent high just at the start of the month, but because of a little bit of profit taking on lighter volume, light to moderate volume, this one might present a little bit better opportunity because it really hasn't participated in that move to the upside. Let's take a look at the next stock, Netflix. Netflix having a really good day today. It's up following last night's Emmys. But the weekly chart, this is a daily chart here. You can see we're up nicely today, up 3.4%. But you got a double top above 370. We haven't even tested that level. And the weekly chart tells me to be careful here with Netflix. Great company. We could just take off and continue moving higher. This has been a really good performer. But keep in mind that just a couple years ago, the stock was down under $100, probably down at about the 80 area. And we just went up over 400. So the company has risen fivefold in about 2 years. It could use a little bit more consolidation. And with higher prices, you can see the lower PPO reading here. I wouldn't be surprised if this consolidation continues and maybe even take a shot at 300 to the downside. I'm not saying it's going to get there. What might happen is that 50-week keeps rising and maybe we just consolidate for a while. But Netflix could use a little bit more consolidation and try and get that weekly PPO back down closer to the center line. And at that point, Netflix, I think becomes a much better reward to risk trade. How about Cracker Barrel? We'll get into some earnings news here. Cracker Barrel, I mean, they really blew their earnings report, and it didn't blow it out. Just didn't do well. The earnings per share, $2.19. Market was expecting $2.69. The revenues, $110.9 million. Market looking for $125 million. Then they went on to guide fiscal year 19 revenues and EPS lower. And you can see we gapped below the recent price support, tried to come back up intraday, and now we're going right back down again. Look at the volume on this selling. I don't like it. I think if we pull up the relative chart, you will see that the top occurred back in January. We have been drifting lower. And on a relative basis, even before today's announcement, Cracker Barrel relative to the restaurants and bars index was at about a 6-month low, very close to the 6-month low. So this was not a stock that was actually, I would have been expecting big results from. They underperformed. They lowered their guidance. They gapped down. This is not a stock for me. I would avoid it. APOG, another earnings-related stock. They actually beat top line, but they missed on their bottom line, 72 cents versus 75, and then went on to lower their fiscal year 19 revenues and earnings per share guidance. So it's really an exacta where you've got not only the missed EPS in the current quarter, but now we're lowering guidance going forward. That is never a good sign. And if we take a look at the relative chart, it is actually had been a pretty good performer up until just a couple months ago. And maybe the relative weakness was telling us something, but certainly today's gap down in a group that is already not very strong, I would avoid it. I don't see any reason to try to bottom fish on APOG. Let's take a look at General Mills. General Mills came up short of revenues, but they beat on the bottom line, 71 versus 64, and then reaffirmed guidance. And the market's saying we don't care. Big volume. It's been selling off essentially since the open. I think you're probably going to find some support down around 42.75 to 43, where we had some recent buyers come in, step in. But check out where General Mills is relative to where it was back in January. And again, relative to its peers, it really hasn't been performing very well, maybe a little bit of relative strength the past 6 weeks or so. But you can see since January or the end of 2017, we really have struggled on a relative basis. And look at relative to the S&P 500. General Mills is not where you want to be. And I think this move lower kind of underscores that. AutoZone. AutoZone, big gap down. We got the hollow candle. Mentioned this one at the top of the show as well. They did come up short on revenues, but they beat bottom line, 1854 versus 1788. I didn't see anything about future guidance. I don't know if they actually provided any. I did not see in the news I was looking at. But the market, after putting in higher highs with the lower PPO, negative divergence, we got that gap down. I think it really, for me, just depends how we finish today on AutoZone, because we do have increasing volume. If we could creep back up above that 50-day moving average, I'd feel better about it. To the downside, there's no doubt in my mind at this point now, 710 is going to be a stop area if I own the stock. I do not want to see us reverse back down and go below today's open. So keep that in mind. Just a couple more here. FedEx. FedEx reported revenues above expectations, but they came in way short on earnings per share. $3.46. Market looking for $3.78. So about a 10% shortfall here in terms of what was expected for earnings. Lots of support on FedEx down around 240, maybe just below. That's an area that I would keep an eye on. And then on a relative basis, you can see that the group overall still not where it needs to be, not close to that January high. And on a relative basis, FedEx has actually been downtrending. And I think if I pull up UPS, I think we'll see a little bit better relative strength. See how UPS has been uptrending? So the market's been telling us that UPS is a better stock versus FedEx anyway. And if I was going to buy either one of them on the weakness today, it would be UPS. I think you've got really good support down about 117 on UPS. As long as that holds, I would be okay in that one. But on a relative basis, I think the market is picking UPS, and that's the one I would go with as well. Oracle, talked about this one a couple weeks ago, saying, might not have a very good earnings report based on the way it's been trading. Let me pull up that relative chart. It did gap lower earlier today. They missed on revenues, $9.2 billion versus $9.28 expected. But they beat on the bottom line, 71 versus 68. And the thing I think that's helping the stock is that they increased the buyback by $12 billion. So I think that traders maybe gapped down. We held on to price support, and then buyers jumped in thinking that we would probably hang on to this price support area around 47. I would be watching probably, I'm going to say 46.5 to the downside and 50 to the top side. That would be the trading range for me. You can see software stocks in general continue to move higher. Oracle on a relative basis has not been a very good performer. And even with this news today, and it's up a little bit with the buyback, it's still underperforming the software stocks today, which is extending the underperformance that it's seen throughout 2017 and 2018. So I don't see any reason to be overly excited with Oracle at this point. I would simply just avoid it, look for other software stocks. I mentioned earlier that part of the reason that second half of September is weak is we see some warnings. Steel Dynamics actually came out this morning. They issued downside guidance. Earnings per share expected to come in at $1.70. They said the number is likely to be 164 to 168. We actually gapped up a little bit. Maybe it's a sell on the news. I mean, we've been going down for the last couple of months. Maybe it's more of a sell on the news, buy on the rumor kind of, or sell on the rumor, buy on the news, sorry, kind of a situation. But I think the key level for Steel Dynamics going back, no doubt, is at $42. We have tested that level time and time again. I think we're just simply trading between 42 and 52, and we're currently at 47, which is dead in the middle of it. So I see nothing to do here. Technically, I think the stock's held up pretty well with its warning today, but I'm not seeing anything that tells me to jump into the stock. I would pass. And then the final one, another warning came in today. Borg Warner, BWA, lowered their third quarter EPS guidance and then lowered their fiscal year revenue and EPS guidance due to weaker industry volumes, primarily in China. Now, they haven't broken down, but you can see the group has been trending lower. Overall, we're continuing to kind of drift lower as well in the stock. I don't see anything that would suggest that I want to jump in here, except that we do have price support at 42, and we're trading at 42.64 right now. We did bounce off the earlier low 42.11. I think we're in a downtrend, a little bit of a flag pattern, bearish flag, which I am not a fan of. So I would pass, but those of you maybe looking at price support could take a shot. Maybe we get a couple bucks back to the upside. Anyhow, those are the stocks that I wanted to go over for inside the lines. There you see them on your screen. What you hear in the news is not always what you see on the charts, and that's why we do this segment. Okay, well, we're going to wrap up the show here in just a couple minutes, but why don't we pull up that poll? I think we had an interesting poll, Erin.
Yes, we decided to ask about scanning since I did my workshop on scanning, and I was curious to see how many people use it. I'm glad to see that the 8% is there because that's a very small number of you. So the fact that we do at least have members in here, even if they're not using the scans, I thought that was interesting. But hopefully more of you are going to be interested in trying out those scans now that I've given you a little bit more information. And the price alerts, the technical alerts are very, very handy because I know I use them they alert me whenever I get signal changes for the decision point timing models. So I get an email at the end of the day, and I really like it.
Yeah, I think if that yes percentage is anything less than 100%, then I would question why. Because it doesn't matter what style or trading strategy you have, there's a scan that you can run. I mean, there are thousands of stocks out there, and there's no way that you can more quickly, trim that list down than to run a scan. I thought the scans you showed, Erin, how quickly you can go from several hundred or even 100 or 200 stocks down to a much more manageable list by using the scans. It's so important to save time. I use the scan every single day, and usually against my strong earnings chart list. But I don't understand. I mean, we talk about the most important thing to us at stock charts, and that's always one of the top, 2, maybe 3 things that I think that you really need at stock charts.
Oh, absolutely. And I remember when they were interviewing us for ChartCon videos, they asked me, what's your favorite tool on stock charts? And scanning just immediately popped out of my mouth because that's exactly, I use them every day and I use them frequently for the show. They're just invaluable. And like you said, a huge time saver. Really great. I mean, before I was with stock charts, we were looking at spreadsheets, as I'm sure you probably were, just scanning down. I only had a very set small number of stocks that I could look at, and it was a visual thing most of the time. So,
yep. And I would also say the 7% that aren't members, try it out. You'll never go back.
That's exactly right.
All right, well, we got some key guests coming up. You can take a look at your screen. I do want to thank everybody for joining us today. Appreciate that workshop, Erin. That was a great job. Remember to complete the survey as you exit. I know Erin would love to get your feedback there on what you thought of the workshop today. And as a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Tuesday afternoon, everybody. Hopefully see you back in here tomorrow. Happy trading.